company. The auditor's report is seen not to be explicit enough, hence, it creates room for expectation gap. However, this chapter also includes what? On the true and fair view. That is, in expressing your opinion, this audit report, there will be definitely true and fair view. That is, the audit report is going to show the trueness and fairness of what? Of that financial statement. If the account is true, is prepared truly and it is fairly what? Presented. Then this chapter also talk about the unmodified audit report. Now, this chapter also talks about the elements or the basic contents of or features of unmodified audit report. So, unmodified audit report is the same thing as unqualified audit report. That is, any report that does not have any material misstatement, or that the auditor did not report that the account does not have any material misstatement. That is what we call unmodified audit report or unqualified audit report. So these are the basic contents of unmodified audit report. We said we have the title page. Don't forget that this kind of question came out in the class we treated last week. But the way the question was asked, most of this thing here was not present in that question, because most of the way the question was asked, that the key audit features, not the basic. They said the key audit features. So let's go. They said the following are the elements or the content of unmodified audit report. We have the title page. We have the addresses, that is the address of the what? Of the company, the auditor's opinion, the basis for opinion, the going concern, the key audit matter. That is ISA 701, if it's any. I've explained the meaning of key audit matter, but we are still going there. The key audit matter, other informations, then responsibility of management for the financial statement. That is, it is the responsibility of management to prepare financial statement and also detect and prevent fraud. The responsibility of an auditor is to form an opinion on the financial statement prepared by the management. The other important responsibility, if it is applicable, the name of an engagement partner, if it is applicable, the auditor's signatures, the auditor's address, and the date of auditor's report. These are the basic elements of audit report. Now let's go to key audit matter, ISA 701. What is key audit matter? I've explained the meaning of key audit matter before now, but for the sake of this class, I'm going to re-explain the meaning of key audit matter again. Key audit matter, they are the significant matter that auditor come across while auditing the financial statement of an organization, but does not relate to financial information, but have significant effect on the financial statement. That is, the key audit matter, they are the matter the auditor accounts are doing auditing the financial statement. They did not relate to the figures. That's what we mean by financial information. They did not relate to the figures in the financial statement, but however, they have significant effect on the financial statement of that particular organization. So in that situation, if we see something like that, we need to report it as key audit matter, which is ISA 701. So that's all about key audit matter. Then others. So example of key audit matter, I think I've been saying it here in this class. Example of key audit matter might be poor revenue recognition, poor asset valuation, then poor impairment of assets, or poor inventory valuation. These are the example of key audit matter. You can see that they did not have significant, they did not relate to financial figures. They did not relate to word to word, figures to figure in the financial statement, but they have significant effect on the financial statement of that particular organization. If care is not taken, it will to run down the organization. So if there's any transaction like that, it should be reported as key audit matter according to ISA 701. So, how do you communicate the key audit matter? The communication of key audit matter, how do you communicate it? Then we communicate the matter to the people in charge of governance for us to for them to know what they are going to do about it. So the other aspect of key audit matter can be modified opinion. So modified opinion is an opinion paragraph that requires auditor to explain the basis of modification. That is modification paragraph rather than key audit matter. Now, let me explain. I think we have time to explain more about this now. So, this modified opinion, according to ISA 705, the modified opinion, it is not substituted to key audit matter, but however, they express a modified opinion in any way. Unlike key audit matter that require, that is, any matter that require modified opinion shall be explained in the basis of modification paragraph rather than key audit matter. I will say it again. According to ISA 705, key audit matter is not substitute for expressing modified opinion. But however, any matter that requires modified opinion shall be what? Explained in the basis of modification paragraph rather than key audit matter. So let's proceed again. Then going concern uncertainty. So this is where we are going to. One person asked me, so who was the person that asked me the going concern paragraph that time? Okay, let me just explain. So let me just explain that aspect. So by then, let me just proceed. So when we get to that aspect, we can now ask very well. So now, the going concern uncertainty, which is ISA 570, they said the going concern uncertainty is a situation whereby the auditor is expected, it is expected for the auditor to include it in the auditor's report. And material uncertainty in relation to what the going concern. That's what the paragraph the person is talking about. That is, any if there's going concern uncertainty when auditing the financial statement, there should be a paragraph that will describe the material uncertainty in our audit report. So this chapter also talks about going concern, that is, in a situation whereby the auditor has substantiated that there is going concern uncertainty, that shows that the auditor have to create a paragraph where it's going to explain going concern uncertainty in the auditor's report. That is that. And the paragraph relating to to that is when there is uncertainty, going concern uncertainty, then the auditor must however explain and describe the situation in the paragraph or in the auditor's report. Then the next one is emphasis of matter. If there's any emphasis of matter, any matter or any fundamental where matter are seen to be fundamental to the users of financial statement, that is, where matter seems to be very, very important, that is, the auditor may highlight it or draw the user's attention to them using key audit matter. That is where this is the situation whereby the company is trying to hide something, and in the long run, it's going to have effect on the financial statement, and thereby the auditor can also have issue with it. So whereby the investors can also be lured to invest in that account. So the auditor can also do what? Can also emphasize on that matter in the auditor's report. Then lastly about that is other matters. If there's other matter according to ISA 706. Other matter might be the matter that are presented that are related to disclosure in the financial statement, maybe related party disclosure or any disclosure at all in the financial statement is generally regarded as other matter according to ISA 706. So any matter like that, it will also be reported in form of P audit matter under auditor's report. All these things I've been mentioning, the modified opinion, the going concern certainty, the emphasis of matter and other matter, they are the matter that will be presented or recorded under key audit matter. Then this chapter also talk about the requirements under CAMA 2020 on auditor's report. Then this chapter also talks about the modified audit report. So the modified audit report is a report that is issued when the auditor identifies significant issues in the financial statement. That is modified audit report. Unmodified audit report, that I said later in the beginning, that they are the reports or normal reports where the auditor does not what identify any significant issue in the financial statement. So it's going to call it unqualified. But where there's issue, they are going to call it qualified. You can see that they use indirect word to express something that is good. If they say, the auditor, I'll just qualify your account now, I'll qualify your report. Now, if auditor is saying that, I'll just qualify your report now, you'll be thinking that, oh, the auditor says that, oh, I will just make good reports about your company. It's saying that I will just report all those significant matter that I have seen when I'm auditing your company's account. That is the meaning of qualify or modify audit report. But when it is unqualified, it means that there is no issue, the account is fairly presented, and it is free from material misstatement. That is what we call unqualified or unmodified audit report. Then other matters, if there's any other matters, should also be disclosed in the financial statement in the auditor's report. Then again, the circumstances where emphasis on matter paragraph are necessary. So for that person that asked me that question before, please, I want the person to even raise up his or her hand to ask me that question again so that I can re-explain. Okay, let me just open my this thing. So Mrs. Lawa, Mrs. Kyra, please go on again so that you can rephrase your question.
Oh, okay, yes, sir. I was asking about emphasis of matter paragraph and other matter paragraph. Like, if you can explain it. Yes.
Okay. So any emphasis that should be presented in the auditor's report, these are the emphasis. These are what I explained here. That is emphasis of you said emphasis on what?
Emphasis of matter paragraph and other matter paragraph.
Okay. Emphasis of matter paragraph and other paragraph. It is necessary. First of all, where they make emphasis on a matter paragraph, it is when, first of all, there's going concern uncertainty. And these are the conditions where they can make emphasis on matter paragraph. See, number one, where an uncertainty relating to future outcome of exceptional litigation or regulatory action. That is, when there is uncertainty that uncertainty of future outcome, that is, maybe the company has case in the court and it is not certain that the company is going to win the case. And if the company did not win the case, it's going to have adverse effect. It's going to have adverse effect on the financial statement. It is necessary to emphasize it in the matter paragraph. Do you understand that one as one of the bases, Mrs. Kyra? Mrs. Kyra, yes. Do you understand?
Yes, I do. Yes,
I hope I'm communicating. That is,
yes,
where there is uncertainty relating to outcome of future uncertainty relating to what future outcome of exceptional litigation, that is, they don't know the outcome of that court case, if the company is going to win or lose. But in a situation that the company lose, it's going to have effect on the financial statement. So the auditor needs to what? Make emphasis to it under matter paragraph. That's number one. Then again, a significant subsequent event that occurs between the date of financial statement and the date of auditor's report. That is, in the case of adjusting event, that is, all those things that can make the company to lose its credibility and the likes, but the outcome is yet unknown. So, but from what you are saying, you see that it's not likely for the company to have a good edge in this situation. So you have to put it in the matter paragraph so as to explain your own way, to let the public know that the company is actually handling any court case. So now, if you now invest in the company, maybe the company now later liquidates, you not say that it is the auditor that misled us. So you are definitely going to see. So because the auditor is going to put it in other matter paragraph. Then another one is where there is new IFRS where the new IFRS is adopted, when there is new IFRS standard that is adopted, and the company is here to do what? And the company is here to adopt it, or the company has adopted it, and which is going to probably have effect on the financial statement. Then the auditor is expected to do what? To make the emphasis in the matter paragraph. But the last one is to draw the attention to the occurrence of catastrophe. That is, in the case of going concern uncertainty, whereby the company has been making loss for a particular period of time, and you just find out that there's a need for then, if the company did not report, there's going concern uncertainty there. Then, however, the auditor is going to report that situation in the matter paragraph. Do you understand now?
Yes, I do. Yes, I do. Thank you very much.
Do you understand now, Mrs.
Yes,
Farah?
I do.
Or you have disappeared again?
I'm here.
Yes, hello, is she there?
I'm here. Can you hear me?
Let me lock my class again. You just disappeared now.
I did this.
Okay. So, thank you. I can hear you. I can hear you. No problem. I can hear you. It's fine. No problem. So, thank you. Now, let's go to. So, that is that about circumstances where necessary emphasis of matter paragraph can be stated. Now, we will also proceed to our modified opinion and the types. That is according to ISA 705. What is qualified opinion? I've already mentioned it. I've already said the meaning of qualified opinion. That is where the financial statements have significant, when the auditor has realized that the financial statement has significant issue that will have adverse effect on the financial statement. That is where they issue qualified opinion. Then the adverse opinion. So on the aspect of adverse opinion, the adverse opinion is type of opinion given by the auditor where there is material misstatement, and such misstatement is almost affect all areas of financial statement. That is, you give adverse opinion when the auditor is of opinion that there is material misstatement on the financial statement, and that misstatement affects almost all the area of financial statement, then you can issue adverse opinion. But qualified opinion is just that the auditor give an opinion where there is material misstatement or limitation of scope on the audit work or on the financial statement generally. That is where the auditor can issue qualified opinion. But adverse is when the auditor is of opinion that there is material misstatement on the financial statement, and the misstatement affects all the areas of that financial statement. That is where you can issue adverse opinion. Then disclaimer of opinion. It arises when the auditor is unable to obtain any any sufficient and appropriate audit evidence at all. When the auditor is unable to obtain any sufficient and appropriate evidence, that is, was unable to obtain the quantity and quality that can be used as audit evidence, it can issue disclaimer of opinion. That now the disclaimer of opinion, that just like what I said before in the beginning, that so it is now left to you to decide that, but auditor will relate that, oh, I was not be able to gather sufficient and appropriate audit evidence. So, but it's not depend on you, the investor, if you want to go ahead and invest in the company or not. But I'll make that disclaimer that if anything goes wrong, I'm not to be blamed for it, because I'm unable to I'm unable to ascertain or obtain sufficient and appropriate audit evidence. That is that about disclaimer of opinion. Then other information and auditor's responsibility. What are the other responsibility of an auditor? Detection of fraud. These are the other responsibility of auditor. So then let's proceed. Then comparative information. The comparative information about ISA that talks about that is ISA 710. And the comparative information is where the auditor give qualified opinion in the previous financial period and the problems still remain unsolved. So those are the one of the comparative information that need to be also be addressed. That is the auditor give qualified opinion in previous financial year, and those issues that auditors have not been worked on. That is one of the comparative information. Or where auditor find out that there is material misstatement in prior financial year and which unmodified opinion was previously given. That is, the auditor now found out that there is material misstatement in last year account, but the auditor give unqualified opinion that the account is not free from material misstatement, that the account is free from material misstatement. But however, when you are now doing your investigation or doing your audit, you now find out that even last year itself, there is material misstatement, but the auditor tell that the account is what is okay, but the account is not okay. So if there is any matter like that, it will be reported under comparative information according to ISA 710. The impact of going concern on auditor's report. What are the impact of going concern on auditor's report? Where there is a going concern issue, what is the impact of on the auditor's report? It shows that it's just that auditor is just going to make an opinion that based on the audits of financial statement of the organization and comparing the 5-year financial summary, then it can be ascertained that the company going concern uncertainty is not what there is going concern uncertainty, that is, there is a assumption that the company might not stay long in the market because of their incessant losses over the year. So if there's any issue like that, it is their standard that talks about it is ISA 570, and this chapter also and it's related to audit evidence. Then communicating to those in charge of governance. So after everything, if there's any issue, how do we communicate? So the ISA that talks about it, that we should communicate our findings to the people in charge of governance, that is, to the directors or board of directors that can make decision in that particular organization. Then again, communicating the efficiencies of internal control to those charged with what? With governance. That is, if there's the efficiency in internal control, where the internal control is not working fine. Please, I hope you can hear my voice. So, am I audible enough? Please. Let me see your emoji if you are still following. Yeah, people are not much in this class again. From my 100 and something to 92. I'll be 200 and something to 92. Is well. Okay. So, on that, we are going to, if there's any deficiency in internal control, the way to communicate it is according to ISA 265 is to communicating the internal control deficiency to what? To the people in charge of governance. Then another one there is management letter. Now, what is management letter now? This management letter is the letter sent by the auditor to what? To the organization. Sent by the auditor to the organization, explaining the audit observations, the effect of the observations, and the recommendation of those observations on the financial statement that need what? Management attention. So this management letter is just like a letter sent by an auditor, whereby you report all your findings. That is, where the company is not doing what they're supposed to do, you put it in your management letter. That is maybe under payables now, they remove statutory deduction like pension or payee. They remove it from staff salary and they did not remit it to FIRS. And when you notice that, you now put it in your observation that no non-remittance of what? Of statutory deduction. That is your point of management letter. So you just now explain in your management letter that we observe during our audit work, we observe that the staff statutory deduction that was deducted from staff salaries was not what? Was not remitted. So you now give them the effect that is it can cause fines and penalty for the company. It can cause financial damage for the company in the aspect of where if the fine is too big, it can cause the financial damage and even damage to company's reputation. That is the effect of non-remittance of that statutory deduction. What is now your recommendation now? Is to give is to immediately pay the what? The outstanding of what? Of statutory deduction that have not been what? Been remitted. So that is your suggestion. So the management letter is letter sent by the auditor to the what? To the organization, in explaining the points noted during the audit process and the effect of those points on the financial statement, and also the recommendation that the company can use to attack the situation. So that is that about the chapter review. So far, so good. Please, any question generally before we proceed? Before I will now give us the tips again, before we now call it before we now close the class and see you during induction program. So any question, Mr. Benjamin, please go on. The class is yours, Mr. Benjamin.
All right, thank you very, very much, sir. We are really grateful, sir. God bless you, sir. Okay, so my question is on this expectation gap. Okay, so I tried to see if I could understand what the three elements in the expectation gap is talking about, but it's really not making sense to me. I don't know if there's a way you could maybe simplify it so that I could understand. That's the standard gap, performance gap, and standard gap, performance gap, and liability gap. I don't know if I'm correct.
Okay. Standard gap, performance gap, and liability gap. What do you understand by expectation gap?
Me?
Yes.
Okay. From my understanding, I can see expectation gap can simply be defined as the difference between what users of the financial statements expect of the auditors and what is expected of. That's the difference between what users of financial statements expect from the auditors and what the auditors are required by law to do.
Exactly. So now, do you know that these three things you ask me now, you know it, but just I don't know how to put it down. So now, one of the types is what? Is standard gap. Abi?
Yes, sir.
Hello?
Yes, sir. Yes, sir. Yes, sir.
Okay. Standard gap. Okay, I think I have this thing here. Let me just hold on, just let me open it and see how best I can explain better. I think it should be in chapter 4. Yes, it should be in chapter 4. think it should be in chapter 4. Let me see. Just hold on. Oh, hold on. It's not in chapter 4. It should be in. Okay. So now, the performance gap now. This is the perception that the audit work has fallen below the what? The standard levels. That is, it is the belief that the level of work, the work procedure, the commitment, and the opinion expressed has fallen below the standard. This gap reduces the level of reliance on the opinion expressed by the practitioner. So that performance gap, it is the perception that the audit work has fallen below the standard. That is, it was believed that the level of work, the procedure of that work, and also the commitment put in place, and the commitment put in place in order to form opinion or on the financial statement has fallen below the standard. That is why they call it performance gap. Let me say it again. Let me try and explain that in normal term. Are you with me, sir? Mr. Who is the person that Mr. Benjamin?
Yes, sir, I'm with you. Yes, I'm with you.
That performance gap now, they said it is a perception that the standard is a perception that the audit work has fallen below the standard level. So why did they believe that it has fallen below the standard level? It's because the work procedure, the commitment level, the work procedure, the commitment level, and the level of work performed by that auditor has fallen in order to express that opinion that the financial statement is of true and fair view has actually fallen below standard. So it's now make the organization not to place reliance on that opinion. This is what they are saying in essence, that we believe that the audit work has fallen below standard. Why? Because we feel like the standard of work that we used to know, then the work procedure, this the approaches, the step, the system you use to audit that financial statement, and also the commitment. Oh, maybe I put my total 100% commit in it, or okay, I put my full support. All my staff that are working very well, they are working excellently. That is, those the work procedures, the commitment of work, and the performance of that work, in order to express the opinion that you give to us in the financial statement, has fallen below standard. That is why it make the management not to place reliance on that opinion given to them. So it is tagged as performance gap. Do you understand the way I explain like that, sir?
Yes, sir. Yes, sir.
Do you understand, or do you want me to rephrase again? It's the performance gap now. The performance gap is telling us that the audit work has fallen below. There is an assumption that the audit work has fallen below standard because the work procedure, the work commitment, and the level of work put in by an auditor to express opinion on that financial statement cannot be placed reliance on. So that is why we tag it as it has fallen below what? It has fallen below standard level. It's saying that, are you a Yoruba person? No. But do you hear
No,
Yoruba?
sir. No, sir. No, sir. Let me see. No.
Okay. So they are okay now. Maybe let me see now. You work as do you work as an auditor or an accountant? I want you to just. So I hope
None,
this
sir.
question is not personal.
None, sir. None, sir.
No? Okay.
Yes, sir.
Let me assume that where you are working, your guy tell you to give report to be among the people or the team lead that will go and supervise a project. Do you understand? They know that. So clearly understand the meaning of expectation gap. I'm not going to put that one in. So they told you that go and supervise a project. They know your capacity, that you can do well in that particular field. That is why they choose you. So when you now came back and you give them results, they now said that, oh, don't let us call Mr. Benjamin. Let us call me another person to come and review this work. I'm just doubting the work of Mr. Benjamin. So, and in that, they feel like the work procedure that you normally use before, the commitment, at least the way you work on that project, and even the work level, maybe maybe you're supposed to stay for like 7 hours on the job, you just spend 4 hours, you carry your bag, you are going home. That is what they mean by the work level, the work procedure, that is the step-by-step, the strategic way to use, the strategic way to use on the work, and also your commitment level, the way you put your mind in the job, has fallen below standard. And that is why the management or your organ couldn't place reliance on that report you give on the project. So in that, they term it as performance expectation. Do you understand like that, the way I explained that one?
Yes, sir. It's fine now. It's fine now. Thank you.
Okay. So now, let's move to the second one, which is liability gap. They said the liability gap is the perception that auditor is liable to everyone. That is, it is lack of understanding that auditor is responsible to everyone, so can be what? Sued by everyone. The liability gap is telling us that there is perception that auditor is liable to everyone. That is, auditor is answerable, that if there's any deficiency in the financial statement, auditor is liable to everyone. They have forgotten that it is the lack of understanding that the auditor is not responsible to everyone, so that it can be it can be sued by what? Everyone. So what that liability gap is that there is perception that so far as an auditor, it is liable to everyone. If there is anything in the financial statement, it's going to be liable for all those things that goes wrong in the financial statement. But they have forgotten the understanding that auditor is not responsible to anyone. Auditor is only responsible to what? To people in charge of governance. In fact, auditor cannot even give the manager of the organization the report. It can't. It can only give it to the board of directors, present it at their annual general meeting, that this is the audited financial statement. So the liability gap is that there's perception that auditor is liable to everybody, and to everyone, and auditor can be sued for anything, whereas there's lack of understanding that auditor is not answerable, or auditor is not responsible to what? To everyone. It's only responsible to the people in charge of governance in that particular organization. That is that about liability gap. They feel like so far as an auditor and is the one that give opinion on this financial statement, we can sue him if there is any auditors or anything suffered by the client. They can sue the auditor in that situation. So this expectation gap is not telling them that you cannot, not everything you can sue auditor for, because auditor is not even responsible to everyone. That is, auditor is not answerable to everyone in the organization. However, auditor is only answerable to the people in charge of governance in that particular organization. Do you understand that aspect now, Mr. Benjamin? That is liability gap.
Yes, sir. Yes, sir. Thank you very
Now,
much.
the last one is standard gap. Now, this is the perception that the auditing standard is more prescriptive than what is actually are. That is, there is belief that auditing standard rules and other relevant regulation used by auditor is more prescriptive than what it is actually be. So what they are telling us there, so I want to just, so this standard, so now this, the, where is it? So this standard gap, when they say something is prescriptive, it means that something has a specific guideline that is mandatory. So that standard guideline, that there is perception that the auditing standard is more prescriptive. That is, the auditors follow specific guidelines. They follow the specific guidelines, and and they are also implying compliance, and they are always mandatory, and they are always directive. That is, this expectation gap or the perception that the auditor is more the auditor is more directive, mandatory, and follow specific guidelines while they are doing their audit work, whereas they have believed that the auditing standard, the rules, and other relevant regulation is used by auditor more prescriptive than what it is actually is. So this standard gap is telling us that people have perception that auditors is more is making things to be mandatory. They follow specific guidelines, and also they are also directive while they are doing their job. But however, the auditing standard, the rules, and other relevant regulation is what the auditor is using to form an opinion. That is why it's making it to be more perspective. So what they are saying is, in essence, that people believe that the auditor are just naturally directive, they are just following guidelines, and they are always mandatory in their dealings. But auditor is not just doing that. They are now telling us that, but auditor is actually doing their engagement according to the standard, rules and regulation, and other relevant regulation that guide the audit work. I'm not sure if you understand the way I just put it like that, Mr. Benjamin. Hello, sir.
I think, yeah, I think partially.
So let me now explain finally. Now, there's perception. I don't want to use that prescriptive. There's perception that the auditors are always directive. They are mandatory, that they used to compel everything on us, that, oh, this is what you must do. This is what you must do. That is the perception. But the real work is that the auditor is not just doing all those things because they are directive, or they just want you to follow specific guidelines. Auditor is actually doing that because they are following the specific rules and regulations that guide the profession. That is different between what the perception that people has with them and the actual things that they are actually doing. People just, maybe, okay, for example now, maybe when we are in secondary school, we will see that some prefects, they are just too authoritative. They will just be doing things like, we will not be thinking that, did they send you up to this extent? That is standard gap. But however, those prefects are actually doing what on the instruction given to them by the what? By the maybe the HODs or the headmaster, that if you see any student that came to the school when it is after 8, you should flog them. So then when it's now after 8, you now go outside and you met someone that came late and you flog the person will now be saying that, oh, this prefect service, it took do self. You just make everything hard. Why can't you just pardon us? And you are just making everything to be authoritative. You are just allowing us to follow this specific guideline. Can't you just change? That is the perception that they have about the prefect. But however, the prefect is actually working in line with the instruction given to him by the what? By the principal of the school. So that one you can lay down to standard gap. That the standard gap, it is the perception that auditors are always prescriptive. That is, they are always want to follow specific guidelines. They are always just want to make everything mandatory, and they are always authoritative and directive. Whereas the auditor is actually doing the audit work in line with the set down rules and regulations, the standard, and with a regulatory framework. That is a difference between the performance gap, the liability gap, and the standard gap. I hope I have answered your question, sir. Thank you.
Thank you, sir.
So which other question again? Generally, no question. So this is what we are going to do.
Sir, there is.
Okay.
Please, I don't know, is there a way you can differentiate? Okay, it's like somebody is saying something.
Go on.
Okay. I say, is there a way you could maybe differentiate this management letter, engagement letter, and then written representation, so that one will not confuse one for the other?
Management letter and engagement letter and what?
Written representation.
Let me use an example for you to understand. Management letter. Let me see. Okay. Management letter is the letter sent out by the auditor first, before the commencement of audit, that the client or the organization need to give them the following information that they put in the letter. Maybe that management letter is, you are saying no, it's not management letter. You said okay, I'm trying to explain engagement letter. The engagement letter, it is the letter sent by an auditor to the what? To the organization or the client well before the audit work, for the organization to send or to give out some information. That is, that one comes in first. That is, I'll be needing your trial balance, for example. I'll be needing your statutory document. I'll be needing your management letter for last year. I'll be needing your ledgers. I'll be needing all the things that we are going to use for audit work. I'll be needing it from the management. The letter that I'm going to send by the auditor to the client for them to provide all those information to me is what we call engagement letter. Now, written representation is now that the letter the company will now send back when the auditors comment that everything that you requested for in the engagement letter has been fully supplied to you. That is, so that one now, the company will now reply you back that, everything you said you need in your engagement letter has been given to you for your audit purpose. Now, management letter, it is the letter sent by the auditor to the client, stating the observation the auditor observed during the audit period, explain the effect of those things or the observation on the company's financial statement, and also give them recommendation on the possible recommendation on that issue raised by the auditor. So there are three different things like that. Engagement letter is sent to the auditor, by the auditor to the company for them to provide some information that will be needed, that will be useful for audit purpose. So written representation is the letter sent back by the company that, oh, this, all the information you stated here has been fully taken care of. I mean, has been given to you for audit purpose. Why engagement letter? The letter of management letter? It is the letter by the auditor stating the observation, the effect of the observation on the financial statement, and the recommendation. That is that about the engagement letter, the written representation, and the management letter. Mr. Benjamin, I hope I've answered your question now.
Yes, sir. But which letter does the auditor write to a third party requesting for information about the client he is auditing at the moment? Maybe like the one sent to the bank.
Yes, that is bank letter. That's what we call external confirmation.
Okay,
it's not that the auditor will just carry and just send though. The auditor is going to write the format. There's a format on what the auditor is going to put in the letter. The auditor will now send it to the company. The company will now print those what the auditor writes. They will now put it in their letterhead and send it to the client. So once they send it to the client, the response inside the letter that auditors wrote, that the auditor will now put it that, please send your response to the below email. That is, the company will not know when the bank letters will be responded, or when the bank people or the circularization that you sent out for external confirmation will be returned back to the auditor. But the auditor will inform the company, because those bank or the vendors does not know the auditor. They know the company they are dealing with. So the reason why the company is going to send the letter to the company is because the company is going to print those letter on their letterhead before they now send it to bank. So when the bank is now responding, or any vendors are now responding to the letter, the company is not going to be aware again, because the company is not going to be copied in the response that the bank or the vendors is going to give back to the auditor. Do you understand now, sir?
Yeah, yes, sir. Then lastly, I'm so sorry, please. Then lastly, if a client wants to engage an audit firm, what's the name of the letter, or maybe I don't know how to put it. What's the name of the letter the client gives to the audit firm?
Which one is that?
Maybe if he has successfully, maybe if he really wants to engage the services of an audit firm, what's the name of that document the client writes to the audit firm?
It's not the client though.
Requesting for their service.
You just there is no special this. I just write a letter that you want to request for the service of the audit firm to come and audit your company. It's just normal regular letter now that you just make it. It is when if it is audit firm that raise that request, that's where you can call it proposal. You say it is called proposal because it is you that you want to do the work that writes to the potential client that, oh, me, I want to submit a proposal. I want to do your work for you. This is what I do. This is what I do. That is proposal. But if you now get interest in my firm, you want my firm to audit your company, you just write letter to me that, oh, I will be needing your professional service to audit my company, my financial statement. So there's no special letter or there's no special name they call that kind of letter. So far it's coming from the client to the audit firm. But if the audit firm is the one that make the advances first, it is called proposal.
All right. Thank you so much. I'm grateful, sir.
Okay. So, any other question?
Hello, sir. Good. Thank you for the class. I have a question.
Please go ahead.
Please, sir. You were the time you said that you explained the difference between engagement and sorry, assurance engagement and assurance service. Please, sir. I don't think I was.
I've explained it now.
Maybe I slept off then.
Can you imagine? You slept off. Me, I did not sleep.
Sorry, sir.
Okay. Oh, voila. Let me say it again. Now, assurance engagement and assurance services. We said an assurance services is not it is service provided by an auditor, but not related to audit of financial statements. I'll say it again. An assurance services, it is service provided by an auditor, but not related to audit of financial statements. Example of assurance services, due diligence, whereby an auditor is contacted to come and do due diligence. And where we do due diligence is maybe your company now want to take over another company, or you want to buy another company. So you now tell an auditor to help you to do preliminary investigation. We call it due diligence on this company that you want to buy. That if I buy this company, will I still continue to make profit? This company, are they making profit safe? Are they worthwhile? Hope they don't have going concern issue. So those things you are doing due diligence, and that is assurance services. Do you understand that one, ma? Do you understand that one, ma?
Yes, sir.
You are not speak louder now.
Yes, sir.
Now, assurance engagement. That one relate to audit of financial statement, but not audit per se. That is, that assurance engagement, it is an engagement by the given to you by the what? By the principal. Who are the principal? The principal is the people in charge of governance in an organization. They give you that engagement to come and give them assurance, to come and give them the statement, to come and restate the opinion given by what? By an auditor, or to come and give an assurance on the account prepared by the company accountant, in order to determine if the account is fairly presented and it is free from material misstatement. That one is more like you are reviewing the account again to ascertain that, oh, all the figures reported in the financial statement is actually correct. That is assurance engagement. You want to give assurance. It's related to financial statement. It's related to audit of financial statement, to come and review those figures they put together, if the figures is actually genuine. So in order for the people in charge of governance to now place reliance on the information or on the account prepared by the what? By the accountant. That is why they engage your service as assurance engagement. But that assurance services relates to it is done by an auditor, but it does not relate to review or audit of financial statement. That's the difference between the two.
Okay, sir. Thank you, sir. Okay, sir. Please, I have another question. Please, sir, when are we expected to use emphasis of matter when reporting? Because there was a question I saw. It said draft a report to the management, but when I saw the solution, I saw that it was emphasis of matter that was used. So when are we expected to use emphasis of matter in sending a report, writing a report?
Emphasis of matter, it is when there is certainty that, and when there is going concern uncertainty, that is when the auditor has substantially ascertained that the company is not going to last for a very long time due to incessant loss reported by the company. That is when they can do emphasis of matter, and it is always reported in the audit report. I just may explain that now under auditor's report. I hope I have answered your question, ma.
Okay, sir. Thank you. Because why I asked was the question. They said draft a report, and the report was just emphasis of matter. The rest, there was no
you explain. They are actually expecting you to explain what they mean by emphasis of matter. You said emphasis of matter can be established in auditor's report as matter paragraph when there is going concern uncertainty. So you now further explain that it can actually be other emphasis of matter when new IFRS is adopted, or when there is any court case in the company is into any court case and there is chance of not winning the case, and if the company does not win the case, it's going to have adverse effect on the company's well-being or the financial statement. That is when you can issue emphasis on emphasis on matter in your audit report. So it's just for you to understand the concept that emphasis of matter or paragraph matter, as the case may be, in your audit report is a situation whereby there is going concern uncertainty that will make that can actually impair the existence of the company in the nearest future, or when there is when the new IFRS is adopted, or when there is court case litigation that can lead to financial that can lead to financial disturbance of the organization, or that can make the organization not to be in existence in the nearest future. So these are the reason for emphasis of matter, and as the all the paragraph matters you just present it. I hope you understand it.
Yes, sir. Thank you.
I have a question, sir. Hello, sir.
Please, I just have 6 minutes. By 1 o'clock, I'm going to end this class. Please, let me also rest.
I just want to know the difference. You know, during Big Brother Nigeria, they normally call Deloitte to ascertain the votes. So I want to know, is it an assurance engagement or an assurance service? That's what I just want you to explain, please.
I don't know. I don't used to watch that program. It's like people they are wasting my time. So I don't really know what you are trying to say. That okay?
No, take for instance, when people vote,
okay,
they will. It's not only Big Brother. I'm just using that one as an example. Maybe when the vote is collated, they will call an auditor to come and give assurance that it to authenticate the. How will I even put it now?
Does it relate to that company? Does it relate to audit of financial statement?
No, it doesn't.
That is assurance services.
Okay. All right.
That is assurance services.
All right. Thank you, sir.
All right.
So, Michael. Hello, sir.
Sir, please, I want to ask regarding comparative information. Can you please throw more light on comparative information?
How?
Yes, sir.
Check your standard now. All this thing you are asking me is just there in your material that you can read and understand very well.
Okay, and one more thing, sir. I'm a bit confused about this modified opinion and also this modified audit report. Like, what is the difference?
It's the same thing. And when something is modified audit opinion and modified audit report, they are the same thing. It means that you are actually giving me a report, or you are giving me an opinion that the financial statement, there is significant misstatement in the financial statement. That is why you modify it or you qualify it. But when you are talking about unqualified opinion or unqualified audit report, it means that the financial statement has been fairly presented and it is free from material misstatement. That is why they call it So it's a little bit confused because instead of them to use qualified that, oh, it's okay, they now use unqualified. So in audit, when they said unqualified, it means that it is free from material misstatement. But anywhere you see qualified or modified, it means that it is not free from material misstatement. Oh. That is just the difference between the two. So let me see your comparative figure that you are just asking me. Like I have explained it before now. Comparative information that the audit of figures are not refers to corresponding figures unless the following circumstances. I've already told you before that we need to compare our opening balances and the closing balances of last year. So that's what we call comparative information. We compare the information of last year information that will serve as the basis for this year information to know if they are actually live the, or if the information is actually genuine and it is appropriate one. That is just the aspect there. So it's
Sorry,
not
okay. Sorry, Mr. Idris. I
Thank
want
you.
to okay. Let me stop there. I don't know, maybe this class is going to log us out.
we are actually going to round up the class now in the next 2-3 minutes.
Okay.
Mr. Idris, well done, sir.
Thank you.
Sir, please, I just need more little explanation about expectation gap. I don't know if you are hearing me.
I've already explained this expectation gap before now.
Please.
So why